Welcome to our class in money and capital markets. So our introductory class introduces us to a world of these two key markets, the money and the capital markets. They form the backbone of the financial systems. They provide us with a platform for trade in terms of short and long-term financing. So these markets are there to facilitate efficient allocation of resources, liquidity management, as well as wealth creation. So these are there to ensure that there's distribution of economic development. And in this course, we're going to explore the roles, the mechanisms, the instruments, the institutions, the policies that will govern this financial environment. So let's quickly go through what we know as the financial markets. What are these? The financial markets. So the financial markets are platforms where financial assets like stocks, like bonds, and their derivatives are being traded. And so we can broadly subdivide them into two. We have what we call the money markets and the capital markets. Money markets and the capital markets. So what are the money markets and what are the capital markets? So by definition, money markets are simply markets that deal with short-term instruments. So these whose maturities extend to less than a year, these are called the money markets. So we need to understand what instruments are traded there, what securities are traded under the money markets. I need to be very slow so that you understand clearly. So these money markets are important to know because we also need to understand what instruments fall under the money market. So we have what we call the treasury bills, which are short-term securities that are issued by government, usually maturing in 91 days, 182 days, or 364 days. These are the periods within which these securities mature. Then we have commercial papers. Commercial papers are unsecured promissory notes, usually issued by corporations. They're used to raise funding for short-term needs. So we have also certificates of deposit. These are time deposits that banks will offer with a fixed interest and maturity. So we also have what are called repurchase or repos. These are agreements where securities are sold with a promise to repurchase them later at a time with a predetermined price. So these are the key instruments that are used under the money market. In the capital markets, we have securities that are long-term. So the key is long-term. So in these markets, we are looking at securities whose maturities will hover over more than a year. They include stocks, which we call equity. They include bonds, which are the debt instruments that we use, and they help businesses and governments to raise long-term financing and also to support wealth generation. So these are in the capital market. So we have the key components of the capital market. We have what we call the equity market and the debt market. So in the equity market, we are looking at the market where shares of companies are issued and traded. They provide ownership. They provide stakes to investors. Then we also have debt markets where we look at the bonds and the debentures. Here they are issued and traded, allowing borrowers to raise funding with a promise to paying back with an interest. So this is in the money and the capital markets, respectively. Now we go further on to look at the roles of the financial markets in national economics. The roles of these financial markets, what roles do they play? Okay, roles before we go to the roles, we must understand that in the primary market, the securities are usually known as new issue securities. The primary markets are the only markets that facilitate what we call an initial sale of securities. So here, securities are usually created and sold directly by the issuer to the investors directly through what we call IPOs, which are initial public offerings, through what are called rights issues, through what are called private placements. So the primary markets are therefore mainly used to raise new shares for issuers, whereas the secondary market are markets where we issue previously issued securities. So these ones are traded among investors. Examples include the stock exchange like the LSE, the New York Stock Exchange like NYSE, and also the London Stock Exchange like LSE. So the existence of these markets is to ensure that there's liquid and efficient secondary markets. And other classifications that you need to know, we have what we call OTCs. These are over the counter. Over the counter markets are decentralized markets where trading is directly done between parties, like Forex, some bonds and derivatives. And we also have ETMs, exchange traded markets. These are centralized marketplaces like stock exchanges, but they're regulated. And we also have the derivative markets. These are markets for financial instruments like futures, the swaps, and the forward contracts. Here, these will derive their value from the underlying asset itself. They're mainly used for hedging and speculation. So, I was talking about the role. What role do financial markets play in national economics? So, the financial markets are not merely platforms for trading, they're actually engines that drive economic development. So, their presence and efficiency are key indicators of a country's economic maturity and investment climate. So the role number one that financial markets play is in efficient allocation of resources. Efficient allocation of resources. So they will help to direct funds from the savers, you and me, to borrowers, again you and me, and also from less productive to more productive users. So that is one of the roles that financial markets play. So they are there to ensure that what monies are moved from less productive to more productive avenues. So we call them the efficient allocation of resources. So the surplus from the savers, so individuals like households and institutions with excess income will channel these to deficit units who are borrowers, governments. So by channeling these to most productive areas, the financial markets will increase what we call capital efficiency and improve the total productivity. The second role is that of mobilization of savings. So it is these markets that ensure mobilization of savings. So the financial markets will encourage savings by providing what? Investment outlets and increasing their value over time. So it is these platforms that will ensure so they ensure that they provide a wide range of investment options like stocks, mutual funds, bonds that will encourage households to save and invest for the future and institutions to generate returns from idle funds. So this intermediation process will promote national saving accumulation and essential for capital formation. So the mobilization savings is another second role. Um, then the third is that of liquidity creation. So liquidity we know refers to the how easy it is to convert assets to cash without what? Loss of value. So financial markets are there to enable investors to enter and exit these positions quickly. They will allow businesses and individuals to raise funds at short notice. So these financial markets are very important because they will enhance what? They will enhance attractiveness of investment due to the ease of tradability. So efficient liquidity management also will reduce the cost of capital. It will also increase the viability of these projects. The other important role is that of price recovery. So the financial markets will determine the prices of securities based on the forces of demand and supply. This is very important. So it is through this interaction that these markets will help determine the fair price of the assets, the interest rates on the debt instruments, as well as the exchange rates on these currency markets. So price recovery mechanism is one which ensures that information is quickly reflected on the assets and will promote transparency and efficiency of the economy. Number five, the role is that of risk transfer and diversification. Risk transfer and diversification. So here, derivative instruments and various portfolios will enable markets to participate and to manage the risk. So it is very important to understand that financial markets will provide a mechanism for what? Mitigating or managing risk, including hedging. So hedging, we use derivatives like futures and options to mitigate the price movements. Also enable diversification, so investing in a variety of assets across sectors or geographies will help to spread the risk. So if you have a well-functioning market, it will allow participants to match their risk appetite with their appropriate instruments. This will ensure that there's greater stability and investor confidence. Number six, the last role of financial markets is economic growth and stimulation. So it helps in facilitating investment in innovation. These markets play a very important role, especially when it comes to job creation and GDP growth. So what we're talking about is financial markets will contribute to creating of jobs. So more funds will mean there's more investment. More investment will mean there'll be more production and employment generation. Secondly, under economic growth, there'll be technology transfer. So with efficient capital allocation to promote what we call research and development and technological advancement. So this comes about because of what? Um, the simulation of growth. Then thirdly, infrastructure development. So the capital markets are there to finance big long-term projects like roads and energy. So these will bring in development of infrastructure. And lastly, but not the least, GDP growth and economic growth. So efficient financial intermediation will thereby increase economic output and resilience. So what are the additional roles that financial markets could do? The monetary policy transmission. So through the central bank, we know that using the OMO system that the Bank of Zambia may use to influence what liquidity. They use the financial markets. Also corporate governance. The publicly listed companies, they're subject to disclosure and these regulatory requirements. So the financial markets will improve accountability, transparency, and governance. Now, this will protect you and me as investors. Then also FDI, the foreign investment attraction. So through a well-developed market, it will attract foreign direct investment and also foreign portfolio investments. So this will boost what? It will boost our forex reserves. Are we moving together on the roles of financial markets? All right. So we also look at the instruments that are used in the money markets and the capital markets. What are some of the instruments that are used in the money markets and um, the capital markets? So we have the following instruments. So we've understood that money market is short term, capital market is long term. So the financial markets segmented to money markets and capital markets. Each of them have a set of instruments that are used. So you need to know which ones work where. So also it moves with the risk appetite and funding needs. So in the money markets, we already said these are less than a year. So what instruments work under money markets? We said treasury bills. These ones are issued by the Bank of Zambia on behalf of the Zambian government with maturities that range from 91 to 364. They are usually sold at a discount to the face value. So here the difference between the purchase price and the maturity is what you're going to make as your interest end. They are risk-free in nature because they are backed up by government. You know, government, there's no risk there. The other instruments are commercial papers, CPs. These, although unsecured, they are short-term promissory notes that are issued by trustworthy corporations. So their maturities range from a few days up to 270 days. So they offer higher yield than treasury bills, but carry some credit risk. So they're used for financing accounts receivables, inventories, and short-term liabilities. Then we have certificates of deposits. These ones are issued by what? The central banks. to depositors with a fixed interest rate. So they are usually non-negotiable depending on the market and offer rates that are traditionally uh, they're more traditional than these accounts that we have because they have a fixed tenure. So they're usually suitable for investors who want to invest in low risk, short-term returns. Then we also have repos, which are called repurchase agreements. These are short-term agreements where one party sells a security, typically government bonds, and agrees to repurchase it at a higher price. So these ones are used in the dealership where dealers in government or securities will raise for short-term capital. So the difference in the price is the interest that they make at a repo rate. So they are very crucial in monetary implementation and managing short-term liquidity. Then we also have the bankers' acceptances. These are time drafts, usually guaranteed by a bank in international trade. They will represent a client for a future payment backed up by this commercial bank. So we know this particular individual. So usually they are traded in secondary markets and offer very attractive short-term investments. Then we go to the capital markets. What instruments are there in the capital markets? We have the stocks. Okay, these stocks represent ownership. Stocks we mean what? We mean equity. So these stocks represent ownership in a company. You become a shareholder and you gain in two ways: capital gains from the appreciation of stock and dividends as a share of profits. So they are traded on the stock exchanges like Lusaka Stock Exchange. And equity instruments are subject to volatility, but they offer potential returns. Then we also have instruments like bonds. These bonds will offer, they're actually loans made by investors to the issuers. So the issuer will actually agree to pay back the principal with interest, which we call a coupon. So we have different types of bonds. We have government bonds, corporate bonds, municipal bonds. So generally, bonds are less risky than stocks. They are ideal when you're dealing with income focused investors. Then we also have convertible securities. These are hybrid instruments that can be converted into equity. Equity, you become an owner after some time. So typically, they could be bonds or preferential shares, which later on somebody may decide to say, okay, I want to convert them into what? Equity at a predetermined rate. So they'll provide you with safety and potential upside of equity. So they are attractive to investors who want to downside protection from some participation in capital gains. They want to also participate in capital gains. Other instruments are derivatives, which include swaps and options and futures. So these ones are instruments that actually derive value from the underlying asset. Okay, so these instruments, like swap options, are actual contracts that will give you the right not to. They'll give you the right, not obligation, to sell or buy assets at a price set before a certain date. So you're going to say, okay, you'll be given an option to buy a certain asset at this set at a certain price. Then futures is a standardized contract to buy or sell assets at a future date and price. And swaps are simply agreements to exchange cash flows. Um, for instance, interest rates and currencies. They are agreements to exchange cash flows. All these derivatives are used for hedging, for speculation, and arbitrage. They actually require deep understanding for you to engage in them. And also we have what we call, although not listed here, I talked about them earlier today, mutual funds. So mutual funds are what? These are also important. And ETFs, mutual funds are investment vehicles that pool money from a number of investors to buy a diversified portfolio. Can be stocks, can be bonds or securities. And the exchange traded funds or ETFs are similar to mutual funds, but these ones are traded like stocks and exchanges. They will provide you with liquidity, diversification, and professional management. So now let's look at the financial market institutions and participants who participates in this. So we have banks, commercial banks, exchange rates, insurance companies, pension funds, investment banks, brokers, and dealers. So these are the main players in these markets. So the central bank, which is the apex monetary authority, in our case is Bank of Zambia, whose responsibilities are number one, to regulate the monetary policy in terms of interest rates and money supply. Number two, to supervise the commercial banks. It also is there to maintain stability in the financial system. It will conduct what are called OMO operations, are called open market operations, that will help to manage liquidity. So the Bank of Zambia is there also to issue currency and to maintain foreign reserves. So central bank helps to affect both the money and the capital markets through these policy rates and market interventions. Then we have also the commercial banks. Commercial banks, they offer deposit takings, lending services, and they form the backbone of the financial system because this is a channel through which households like you and me and institutions will make their savings productive. So it's a financial institution that we use, except that today we have also been predominated by the fintech, the mobile monies, etc. But all these, they help into providing what? Money, liquidity. They facilitate for payments and extend credit to individuals. So commercial banks also are there to help provide for certificates of deposits and short-term loans. Then we also have stock exchanges. What are stock exchanges? These are avenues that facilitate buying and selling of securities. So we have the Lusaka Stock Exchange. Those of you who were at the trade fair or shows, make it an opportunity to go and learn from these avenues. Are we together? Are we together? Are you following?
Yes, please.
All right. So I'll do a quick, can you remember? We're about 20 questions that I'll ask you from what I have talked about. This is the introductory class, very important. So these are the key players in the institute. So we also have insurance companies. They are there to manage risk and collect long-term funds. These are insurance companies. Insurance companies are very important in this mainly for risk protection. So where investors will collect monies for long term, particularly in the capital market. So the insurance companies like Madison are there to curb the magnitude of risk. We also have pension funds. These are there to manage retirement savings from the workers, and they invest it in low, moderate risk to generate steady returns for them. So the major players in the capital markets, um, these pension funds. So PIA regulates um, most of these. Okay, so we also have investment banks. Investment banks, they specialize in large and complex financial transactions. So these are very important in that they help to raise um, capital, and also the activities are mainly financial advisory. They advise, they help firms to go public or via IPOs. They also help firms to merge or acquire other firms. They also help firms to issue bonds. Unlike commercial banks, these ones do not take deposits from the public. Their role mainly is large scale and complex financial transactions. Then we have brokers and dealers. They act as intermediaries between buyers and sellers in the financial markets. So these ones, the brokers are there to what? To execute trade on behalf of the client and earn commission. The dealers are there to buy securities on behalf of their clients. So these generally provide market access, research services, and also investment advice. And we also have the microfinancial institutions, MFIs. These ones are there to provide what? Services, like providing microloans, especially to undeserved populations. And they are there to enhance financial inclusion and support the small scale enterprises, the SMEs, and also they operate mainly in developing countries like Zambia, where formal financial systems are less accessible. Then we also have credit rating agencies, CRB. So here they are there to assess the creditworthiness of the issuers to see whether these ones are to be engaged with to reduce the risk associated. So in a nutshell, we need to understand these instruments and institutions in the money and capital markets because it's very important for anyone engaging to make good decisions. So these markets are there to offer avenues for raising capital and managing risk. As well, they serve wide range of participants like individuals, large companies, and governments. They are there to promote growth and they channel funds from productive areas and enhance what? Efficiency. So in Zambia, and other well-developed markets. They contribute mainly to improved monetary policy, also an enhanced financial inclusion. These key. Then we go to the uh, uh, regulatory framework. Okay, regulatory framework, and we also look at the case. Okay, so what is involved in the regulatory framework? So when you're dealing with the regulatory framework, we're basically looking at the law governing um, these financial systems. They are the cornerstone in terms of economic stability, boosting investor confidence, and also having efficient allocation. So the regulatory system is an oversight that ensures that the market will operate fairly, the market will operate efficiently, and also safeguard public interest. So the purpose of these financial regulators in the financial markets are number one, to maintain the market integrity. Number two, to promote transparency and fairness. Number three, to protect consumers and prevent manipulation, and also to ensure that there is what? Systemic stability. So these ones are the roles of the regulatory part. So the other key aspects that we need to know that the regulatory framework or system looks at. These key aspects include disclosure requirements. So here firms must provide accurate and timely financial statements. So this aspect will ensure that um, all participants have access to the same material and information, allowing them to make informed decisions. So usually the requirement is that you must have a publicly registered company, you must adhere to accounting standards, all right? And the benefits that it increases confidence and it would prevent insider trading, where people get leakage of their prices and take advantage, and also promote what? Corporate accountability. Secondly, the other aspect will include market surveillance. So here, um, authorities will monitor trading to detect irregularities. Any questions so far? Any questions so far?
No question. It's clear.
Okay, so if it's clear, we're looking at what the key aspects in the regulatory framework. There's an aspect of what? Market surveillance. So authorities monitor trading to detect irregularities. Okay, so the regulatory bodies are tasked with monitoring trading activities in the financial markets. They are there to detect and to prevent irregularities like price manipulation, insider trading, or excessive speculation. So, uh, also the common tools and approaches that they use is real-time monitoring. These are systems that are there to detect any unusual price or volume movements. Also audit trails where they will investigate any suspicious transactions and flagging of risk traders or firms based on their behavioral patterns. The other is of investor protection laws, where investors will be protected in this institution. The laws will be designed to shield investors, especially retail investors, from fraud and misleading practice. So here, the key features are that you want to ensure that there's a KYC, you know your customer, and anti-monetary laundering, where procedures are there to ensure that integrity is adhered to. that of licensing and regulating of participants. So here regulators will oversee the registration, the licensing, the monitoring of all the financial intermediaries, including the brokers, the asset managers, the investment advisors, the credit rating agencies, the custodians. All these are monitored. So these institutions should meet a certain capital adequacy, conduct, and also reporting standards. There's also international regulations and global standards here. As capital markets become more globalized, the domestic financial systems must also align to international standards. These standards are there to maintain credibility and attract what? Foreign direct investment. Okay, then also enforcement and legal recourse. So no regulatory framework is complete without such. So now we go to quickly um, our assignment question. So the comprehensive information windows that firms provide to markets in form of their mandated annual quarterly filings have changed drastically over time, becoming significantly longer and more complex. When firms break from their routine phrasing and context, this action contains rich information for the future. The paper explores the implications of a subtle default choice that a firm may make irregular reporting practices. Namely, firms typically repeat what they most recently reported using complete history of regular quarterly annual filings by U.S. corporations from 1995 to 2014. We show that when firms make active change in their reporting practices, this conveys an important signal about the firm. Changes the language and construction of financial report. These reporting changes are um, concentrated in managing decision. So with reference above case, discuss the role of financial markets in national economies and discuss implications of shift captured in the mini research above. So in a few key points, I need you to answer this just in key points. What are the roles of financial markets in national economies and what are the implications in there? Due to time, I'll end here. But I've sent a note for today's class. Thank you so much.
Thank you.